The talk of every investor right now. Can you believe, and maybe even more importantly, can you buy into this rally? Let's ask Trivariate's Adam Parker. He's with me again here at Post 9. So we're waiting on these earnings, which are important, especially now. What about this rally? Can it be trusted for anything more than a tradable bounce, a bear bounce? What do you think?
Honestly, I think it's probably just a short-term rally, relief rally. I don't know if we... you ask the question sometimes, do we already see the bottom? I don't know. I don't think so, Scott. I don't think so.
Why?
It's tough to call, but I just think we're in this challenge where we know the earnings estimates are way too high. Now, you could say everyone knows that, Adam. Everyone knows the numbers are way too high, so it's all on the price. But is it really all on the price before we started to see the negative earnings revisions? I mean, the bottom-up numbers for 2023 are about $249. That's the current bottom-up estimates. The S&P's at $39.59, so let's call it low 16 and change times forward earnings. I think the real numbers are probably 215 to 220, not 249. So, are we going to act well when we get a 15% aggregate downward revision the next year? Maybe. I don't think so. Maybe.
Banks weren't all that bad. I mean, Netflix wasn't as bad as feared. Maybe the sky is falling crowd needs to chill out.
Yeah, I'm not the sky is falling crowd. I just think if you look at it reasonably, 10% growth this year and another 9% next year in the consensus numbers. I think what's probably more realistic is 6 or 7 this year, maybe flattish, at least in the first half, or negative next year, and then expanding after that. Again, depending on, what happens to inflation. So I sense that, we will get some tradable rallies in and out, but we're not off to the races, train left the station. I don't buy that when we know we're going to have downward revisions again in October and likely again in January. So I think you're in and out, kind of choppy market. You're not, hey, I feel good, the bottom's behind us.
No,
at least that's right.
Of course, I hear you. And that was.
But I like you playing the positive vibe on an up day, which isn't what we normally do together.
I will play devil's advocate to anybody at any time. Now, Ali McCartney, who was with Sarah in the last hour, sort of made the point you're making now. It's you've got this, what she characterized as a synchronized global transition that's underway. I don't care how positive you want to get on whatever metric you want to hang your hat on. That rules the day more than anything else.
Yeah, look, we know quantitative tightening is different than quantitative easing. We know CPI is going to stay much higher for longer than people think because of rents. What we don't know is how the Fed's going to deal with it, right? We know that they were buying tons of MBS when the housing market was on fire everywhere, so we know that we can't exactly read what they're going to do. And so I think that's the challenge. So when we look at corporate earnings, I don't think the sky is falling. I agree with that. There's not a ton of management excess in terms of hubris, hiring too many people and tons of inventory and crazy new fancy corporate headquarters. But we do think revenue is going to miss. And so what comes when revenue slowly misses is you get, the drop-off in profit. So gross margins probably come down 300, 400, 500 pips. That's how I get from the 249 numbers to what I think the real 215, 220 are for next year.
There are certain reports that carry a little more weight than others. And Tesla is one of those names that's in the lights every quarter, right? Especially given the narrative and the environment that we're currently in. Right. Currently, the banks do because they started off. Netflix did because of what happened with that bombshell last time, and the stock cratered by 30+%. The importance of Tesla right now in this market, given retail sentiment around that name, the NASDAQ, what do you think?
I personally think that it's just a barometer for how people think about what we call hypergrowth stocks, right? Do they feel like taking risks? Do they want to buy things where a lot of the value is way in the future but not today? There's no question that Tesla isn't worth what today's fundamentals show. It might be worth what they show 5 or 10, 15 years from now. So I think if people get confident that things are okay, maybe you get a tradable bounce. But I don't think we're going to sit back 2 or 3 weeks from now and say, oh, you want to go crazy buying hyper-growth stocks that are, somewhat low quality.
Well, but maybe, okay, I'll give you, maybe it's going to be choppy. The summer's going to be a little volatile. It could be choppy here and there. But what if I do say, look, maybe people got too negative? And the move that we've had has been pretty broad-based. Yeah. A lot of the areas that you thought were among the most vulnerable have done well of late.
I think the most vulnerable are industrials, machinery, and capital goods. And they've modestly underperformed the market, and I think they should strongly underperform the market. So there is a disconnect. Machinery and capital goods and estimates generally have It come down a tiny bit year to date. They're for 30% plus earnings growth this year and another 18 next year. Yet we know all of the things are going wrong. Activity is rolled over. Commodities are higher. Currency doesn't help. Wages are. I mean, we can make the list. So I think that's the place where relative estimate achievability is the worst. And as we've talked about before, everyone gets back from vacation in August, sharpens the pencils in September, and says, "Whoa, my 23 numbers need a serious haircut."